Okay. Looks like, yeah, people will be trickling in here now.
Okay. Well, hello and welcome to all of you that are coming in now. Thanks for joining us here in our market update. We're ready. We're kind of very excited for 2024, I would say. Would you agree, DJ?
Definitely. I'm always excited for the new year.
Yes.
There's that fresh start. Uh, I'm an optimistic person too, so with just life in general and the markets, it's always exciting about what are we going to get, what's going to happen this year.
Yes.
So I'm looking forward to it.
Yeah. Okay. Well, let me just maybe do some quick introductions if we could really quick. Um, First, hello. My name is Drew. It's good to kind of be here. I'm here with DJ. So DJ Wright is our director of investments. He's passionate about serving our clients across the nation, providing guidance to help them pursue financial freedom. He received his bachelor's degree from the University of Oregon, where he focused on economics and business. He loves to discover and monitor investment opportunities and is instrumental in crafting the various portfolios that are used for our clients' investments. When he's not working, he enjoys the outdoors, sports, and spending time with his two sons.
Yes, thank you. Go Ducks. Always got to shout out the Ducks. It's my thing. Appreciate it, Drew.
Yeah,
I'm excited to be here with you today. This is going to be a good little webinar. Let me
yeah.
introduce you. So, Drew, you've been with us now how many years?
A little over two now, approaching three.
Approaching 3. It feels a lot longer. We were talking the other day. We all count our half years. It's like we're kids
Yes.
again, right? Like 3.5 years I've been here. But Drew's passionate about taking care of people. He's a client service associate and trading assistant, and assists all the advisors in delighting our clients. When he's not in the office, you can find Drew singing. Pretty neat. You gonna give us a little taste, Drew? You got anything?
Oh gosh, right on the spot.
It's
Hmm.
okay. Next time.
Maybe
Next time
that's
we'll do
right.
it.
Next webinar.
So he's a singer. He's just a music guy, and he also loves sports. He and I talk a lot of sports. We're the sports guys, and also loves outdoors camping in the Pacific Northwest. So thanks for being here, Drew.
Oh, thanks for having me. All right, so just a little bit about financial freedom. Financial Freedom Wealth Management Group was founded in 2001. We are a comprehensive wealth management and planning firm committed to helping our clients improve their long-term success and pursue financial freedom. Um, and who do we serve? Pre and post retirees wanting to build and protect their wealth, people developing and growing wealth, no matter where you are in that journey, as well as business owners needing financial services. And our commitment that we are always striving with and moving forward with is our commitment to care deeply about you and your financial life. And this is our beautiful team. Not everybody is is pictured here. We just had our picture day actually, so we're going to be having some new ones on the next webinar that you'll see. But we do have 7 financial advisors and 14 support staff. Pretty good looking team, if I do say so myself.
Always growing, right? We keep adding new team members, to new great team members.
Hmm. Yes, and so throughout this is going to be a little bit interactive. So go ahead and text your questions to the number that's on the screen there of 458-777-4458. And at the end of the webinar, we'll go ahead and go through those questions and answer them for you. All right, DJ, we're just going to go ahead and give it to you. Let us have it.
Thanks, Drew.
You're
Appreciate it.
welcome.
So today we're gonna first look backwards, look at the last couple of years, just think about where we've come, and then we're gonna talk about this year and into the future. So I'm actually gonna go a little bit further back. We're gonna go all the way back to 2022 just briefly. So if y'all remember, 2022 was the tough year, really hard for stocks, for bonds, just the economy, just the vibe about everything. It was really rough. Um, Remember, we had inflation that was skyrocketing in 2022. So coming off of the pandemic and supply chain issues, and then, you know, the stimulus packages, a lot of money out there. It's a recipe for super high inflation, and we got it. And I think in the summer of 2022, inflation topped out at 9%, which was the highest we had seen since the 70s. So it was tough, and stock market reflected that, and the bond market as well with higher rates put a lot of pressure on bonds. So everything was going down, all your investments, right? And it was really, it's never easy to go through that. There was a lot of talk about a recession. I mean, everywhere you looked, it was recession, recession, recession. It's coming. And 2023 was a little bit different. So it was kind of a complete 180 from the year before. We're calling it the year we tackled inflation. Now we know we're not completely there yet, so the job's not done. We've got it wrapped up, haven't fully tackled him, but we're on our way, So, you know, we made a lot of great progress. So last year in 2023, inflation decreased a whole lot. So we ended the year, it was about 3.4% was the inflation rate versus, you know, 8-9% the year before. So made a lot of progress with inflation. You know, the Fed had been raising interest rates since I think March of 2022, and so that their goal was to curb inflation, to kind of slow things down, and so they did that. And I think the more amazing thing about it all was that the economy was so resilient. So, you know, again, when you're trying to decrease inflation, you're trying to slow the economy down, kind of reduce demand, which then reduces inflation. And so we were expecting a pretty big slowdown from all that. But what we kept seeing in 2023 was these numbers that showed that the economy was just hanging in there so well. You know, we had good GDP numbers, businesses were making money, we had low unemployment. And so that, I mean, that was amazing. Everybody was really excited to see that. And that's where the recession talk kept getting pushed out further and further. We started to see, wow, the economy is resilient. Wow, inflation is coming down. Maybe we won't get that recession, and maybe we will get a soft landing. And we'll talk a little bit more about that. But that's why stocks had such a great year. Lowering inflation and the economy hanging in there very well. Saw stocks come up really good. So we had the S&P 500 that was up over 20%, about 24% gain last year. The Dow Jones was up 13%. And the NASDAQ, which is more tech type stocks, was up over 40%. Now, it also had been really crushed the year before, so it had some more room to go. But great year for stocks. We love seeing that. We started a new bull market, and we're currently in that one now. Let's see a couple other numbers for you. So our GDP, which is our gross domestic product, that's kind of like our total output for the country, was 3.3% in the fourth quarter of 2023. So great growth. That number actually came out just today, this morning. So it was a good year all in all. We were very happy with that. And this last point here, you can see market breadth improved. So the rising tides lifts all boats. This happened at the end of the year. And so what this means is we started to see a lot of the small and mid-cap companies actually do well and outperform some of the larger companies out there. For most of 2023, it was those big names, NVIDIA, Facebook, Google, Microsoft, you know, the big ones out there. There's they call them the Fantastic Seven and the FANG stocks. There's a bunch of names for them, but they really kind of carried the load, and a lot of the smaller companies weren't actually doing quite as well, but the market as a whole looked good because of those big companies. And so we started to see that shift where these smaller companies actually were improving. And that's really important when you're looking at the economy as a whole and the stock market. Having that breadth is huge. So we started to see that, and that's very promising as well. So 2024, here we go. Of course, we never know what's going to happen, right? We're early here in the year. Things have been good so far, but we're just going to look at some things and just show you where we see them. It's an election year, so we get a lot of questions about that, so we'll address that today. Also, markets have been hitting all-time highs, which is great. We love it. Everybody loves it. But then you start to wonder, okay, where do we go from here, right? Where do we go from here? That's the big question. So these are our 2024 annual forecasts. You can see the United States. We'll just focus here. But looking at GDP, which again is kind of how much we're producing, our output, we're expecting things to slow down. So, we're in a higher interest rate environment, and that does slow growth a bit. And so we're expecting that. I think everybody is. So 1% GDP growth is what our expectation is. But still growth, right? We're not seeing anything go negative. We're not expecting that. That CPI, that's really your inflation gauge. We're expecting that to get below 3% to 2.8. So we do think that's going to continue to come down. The goal of the Fed is 2%. That's the sweet spot. That's what they want. We always want a little bit of inflation. That's good. That means that we're moving forward. But once you get above 2-3% is where there can be problems. So they're really trying to keep that, get that back down to the 2% target. Now, will there be a recession? I mean, that's a big question on everyone's mind. Nobody knows for sure. Nobody knows. Okay. If we go back to 2022 and even into 2023, most economists were predicting a recession, saying there's no way we can't slow inflation down without tipping into recession. It's likely to happen. Well, now everything's very different. Most economists are actually predicting no recession, that we will accomplish the soft landing. It's still very possible, and we don't know for sure. We'll have to wait and see. But if it did happen, it's still likely to be fairly mild. We wouldn't expect a huge, deep recession. Could be very short-lived. So let's talk about some of the risks in the economy and with the markets. There's always risks. There's always risks. No matter where we're at, we can always find something. But what's amazing is the stock market kind of just handles those risks, and over the long term continues to go higher. There's a saying that the stock market's built on a wall of worry. And it's so true, no matter where we're at, there's always people who are concerned. There's always things that could happen. And I think it's good to acknowledge them, good to address them. You certainly don't want to change your investment strategy just because there are some risks out there, because again, that's every year. So we'll address these here, but it's not anything that, you need to change what you're doing, right? You want to prepare for these in advance and know that there's always going to be some risks. And again, the economy and the markets are very resilient. But a potential recession, we were just talking about that is possible, right? It is possible we could get that this year. So if we did, again, likely to be mild, and you'd see some initial reaction with the stock market, those short-term fluctuations. But a lot of the pain that we did see the last few years likely was, any potential recession that we could get. Remember, the stock market's very forward-looking, so it's always looking out about a year or even further. So if we did get a recession, say this spring, it's likely that 2022's downturn was like kind of a foreshadowing of that. And then if we get the recession, it's okay, we're looking a year out from now, and we're likely through it. And so the stock market can react positively to that. Another risk is the inflation. If it were to spike again, we're not expecting that, but again, it is a possibility that we could see inflation increase again, and that would change things also, because that would change what the Fed's going to do. And of course, we're on that path, and the markets are really excited about lower inflation, so that would be a change. And of course, geopolitical risks. I mean, I think that's always on the table. It's definitely higher right now with everything that's going on in the Middle East and Ukraine. But, when you look at history, as far as the stock market goes, I mean, there's always geopolitical events going on. Wars do happen, and stock market does continue on through all that. So let's talk more about what's going well, because I think there's more that's going well. There's more to be positive and optimistic about than those risks. So again, inflation is likely to continue to decrease and get closer to that 2% target. So that is kind of the base case. And as that continues to happen, the markets are going to cheer that, and that could be a good positive for the stock market and for bonds as well. Again, bonds had their worst year in 2022, worst year ever, and that was because of higher inflation and higher rates. So as that comes back, we could see good returns with bonds as well. The economy continues to be resilient. So if we keep getting these great numbers, we keep seeing good growth, we keep seeing low unemployment, that tells us that, look, we're not in a recession. When we go through a recession, I mean, you see higher unemployment, that's just the way it works. And you start to see the economy contracting. We're not producing as much. We're not making as much money. And so if we keep getting good numbers there, that could be really good for the markets. And then you can see earnings growth, right? So companies have been making money. That's been increasing, and we do expect that to continue. And we keep getting these quarterly earnings reports, and they're usually pretty great. A lot of positive surprises, companies making more than they had expected. So that's been really good, and that could continue as well. So a lot of good stuff out there, along with some of the risks. All right, so what does the Fed do? That's a good question. Nobody knows for sure, right? No one knows for sure. They had been raising rates very aggressively for, about a year and a half, and they paused in September. So they haven't raised rates further, and they're kind of waiting to see what they're going to do. And a lot of it is dependent on the data that they get, the inflation numbers. Most economists are expecting 1 or 2 rate cuts this year. And I think the markets have kind of, they've built that expectation. So if the Fed had to do something different, right? If inflation spiked and they actually had to keep rates higher or raise them again, that could change things. But right now, we're expecting them to cut rates at some point, probably later in the year. And that's likely if we do continue to see the growth slow and see inflation come down, and then I think that would be the best case scenario for the markets. But it's one of those things where we don't know what they're going to do. They have a tough job. They're really balancing growth and inflation, and they have to get it just right. They're slowing the economy down to reduce inflation, and they don't want to go too far to where they really slow things down, but they also don't want to stop before the job's done and we could see inflation spike again. So I'm happy I don't have their job, but we'll watch and see what they do, and that can impact things. But right now, I will tell you that the Fed is projecting no recession. They've said that they actually think that we will not get one, and I know that they're pleased with what they've seen as far as inflation coming down and the economy being resilient. So let's talk about the election. It is an election year, and that can be concerning for some people. Markets, they don't like uncertainty. That's the biggest thing that spook markets. And so, of course, in an election year, there is some level of uncertainty. We don't know what's going to happen. But when you look at just the history of the markets, election years have been good. It doesn't mean the markets are going to go down. They've been very solid. So here you can see you have the 4-year presidential cycle, and you got the S&P 500 returns, and the different bars show you whether we had a re-elected president, whether we have a new president, and then the average year. So right now we have Biden in the office, and he was a new president. So we're actually looking at the blue bars here for this cycle. Next year, if Biden won, then that would be, a re-elected president, or we could go back to the new president if somebody else came in there. But for this year, it's new president, blue bar, and you can see that year 4 average gains has been 12.2%, which is great. I think everyone's be very happy with a double-digit return. So that's been the average on the 4th year with a new president. You can see that just the average year, right? So count all the years together, regardless of whether we have a new president or a re-elected president, the average gain has been 7%. So again, markets, they don't necessarily care who's in the White House, right? We're investing in companies, not presidents. There can be the short-term volatility, but companies find ways to make money no matter who's in there, and that's what we invest for. It's actually kind of amazing here if you look at the different years. So year 3 of a presidential cycle is historically the strongest, as you can see here very clearly. And last year, I mean, look at what we got. It was right in line with this. So I think that's quite interesting. So again, we'll see what happens, but it's not a situation where you should, change your strategy or anything like that. We have these elections every 4 years. They're very common, and we continue to have them. And you just want to kind of stay put, right? Stick with your strategy. And that's usually the best way to approach it. So now let's kind of dial in a little bit on just stocks and bonds. We talked more about the economy as a whole, but let's talk about stocks and bonds. So stocks. This one is showing us the returns for the 2nd year of a bull market. So just a recap, bear markets are when markets are going down. That was 2022. And bull markets are when markets are going up. That's what we are currently in right now, early in a new bull market. On average, we see, bull markets go 3 to 5 years typically, and bear markets, again, they come every 3, 4, 5 years, and they last about a year. So 2022, we started going down, right? And we hit the low point in October of 2022. And so that's where you can see this here on the far right. That was the low point. And from there, markets started going up, and they've been going up ever since. And so that was the starting point of the new bull market, where markets are increasing. And so October of 2023, we entered the 2nd year of this bull market. That's what we are in right now, year 2. And the average gain in year 2 of a bull market has been 12.6%. And here's what's really amazing. It's never been down. Look, if you can see these here going back to the 1949, the 2nd year of a bull market has always been positive. Pretty good numbers there. So again, it's not a guarantee, right? We don't know what will happen, but when you have a lot of data, which we do with the markets, you can start to put together some pretty good assumptions, and I think it's good to look at. And one thing that history tells us, no matter what you're looking at, it paints a pretty good picture for the stock market. Yes, we do have downturns. Yes, they're never fun, but what we've seen is they always come back and continue higher. If you just kind of glance at all these here, you can see that year 1 of a new bull market is usually very, very good. I mean, look at those. Most of them are in the 30s or higher, which just, again, shows you that, yeah, we can have quick downturns, but then the recovery is usually pretty quick as well, especially bouncing off those lows. That's why you want to stay invested through it all. And let's talk a little bit about earnings. So this is the earnings per share for the S&P 500. So basically, this is a good way to track our companies making money in the S&P 500 and if that's increasing, on average. And you can see it year by year, right? 2020, we obviously had a big dip when everything shut down. And then 2021, we were kind of back on track. 2022, we actually did increase again. And for 2023, we're still waiting on some numbers for the end of last year, but we're expecting it to still be decent. We are expecting a decent increase here for 2024. So you can see up 8% is the expectation. Again, these are just expectations. But I think when you're looking at stock prices and just the stock market as a whole, there are the psychological stuff that goes on, right? People reacting to things that can make short-term moves in the market. But when you actually look at the core of what drives the markets, it's our companies making money. I mean, that's what it is. And over time, they are, and they continue to make more money and grow. And so that's why we see stock markets go up. So I think this is an important one to know that, yes, we're expecting them to continue to increase their profits. Yes, there's the reactions to news and all kinds of things, but that's kind of the fluff in between. This is the core of what drives stock prices. So bonds, they look very, very good. They haven't looked this good in a long, long time. We had a really tough year of 2022. And when the Fed pauses, which they did in September, they haven't raised rates again. Coming off of that, bonds tend to do very, very well. So bond prices and interest rates have an inverse relationship. So as interest rates were going up, we saw bond prices go down, and that's why they struggled so hard in 2022. Last year was better for them. And so when rates stop going up, and in fact, if rates start going down, which is likely at some point, that's when you actually see bond prices go up. So they look really, really good right now. You can see here the 6-month, 1 year, and 3-year returns after the Fed pauses. And on average, 6 months later, they're up 8%. On average, 1 year later, they're up 13%. And on average, for the next 3 years, 10%. These are annualized numbers, so 10% per year, which is, I mean, getting double digits for bonds over a multi-year period is pretty good. So that's exciting for bonds right now. So, if you have that in your portfolio, or you're more conservative or getting close to retirement, it's a good time to add bonds. All right, so always want to remind you that, look, we can crunch numbers, look at the economy, look at election stuff, right? All that stuff, stocks, bonds. Zooming out and looking at the big picture is always really important to remember that the markets do well over time. There's ups and downs along the way, but if you stay invested, you can do really, really well. And here you can see the growth of 10,000 from 1970 to 2022. 10,000 turns into over $2 million. And there was a whole lot of stuff that went on. Lots of headlines, lots of things that, definitely caused that initial reaction in the stock market. Now, if you just stayed put, stick to your strategy, you were rewarded for that. And so that's really important to do. It's not always easy, but keep that in mind. You're in it for the long haul. And even if you're in retirement and you're like, hey, I don't have 10 years, thinking even just a couple of years versus what's happening right now, this month. Most downturns last a year. The average bear market is about 11 months. So even if it's 2 years, 3 years, that can be long term as well. And then this is the last chart I have for you. This is, I think, one of the best charts out there, and it shows the calendar year returns for the S&P 500 year by year. That's your blue bar. That's at the top. That's what you would receive if you stayed invested that whole year. Now, markets don't go straight up. There are ups and downs along the way, and every year we actually do expect usually 3-5% pullbacks and at least 10% pullback every year is what we get on average. And then again, every few years we get 20 to 30% pullback. So it's volatile, but it always comes back. So I mean, if you just kind of glance through this, right, you see the returns on the top are very good. From starting on the left side, 26%, okay, down 10, and then up 15, 17, 1, 26, 15. You can see all that. But then you see the biggest decline during that year, pretty substantial pullbacks throughout the year, but they're short-lived. So if you just stick with it and you don't panic, right, don't sell, then you will get the returns. You would have gotten the returns of the blue bars. If you panicked and sold at the bottom, you'd get the returns of the orange bar. So, it just goes to show that gotta be okay with volatility. It is part of investing, and that's why you can make good money in the stock market, because you can take on some of that short-term volatility. And again, if it's money that you're going to be using soon, there's ways to set it up where you have some of your funds invested conservatively that you live off of when the markets are down. And so we help you set that up perfectly so that your account's ready for the volatility. I mean, we do the work up front so that you're good to go. Okay, so that's what we have for you guys today. I hope you enjoyed what we shared with you. I hope it is an optimistic view. Like we said at the beginning, we're optimistic here, and we love this stuff. So if you have questions or anything like that, you can text us here. We do have some time for some questions. Of course, if you want a check-in, or if you're new to us and you'd like to set up a consultation, you can also text us, and we can get you set up. Here you can see we do offer the complimentary consultation. So again, is no strings attached. We just sit down, chat with you, see if it's, if we can help you, what you're looking for, and if it's a good fit, and then we go from there. I do have to share, so our broker is LPL Financial. They're the ones that really hold your accounts, right? You don't write checks to Financial Freedom. It's LPL, and they're the ones that hold the accounts, and they're one of the largest independent broker dealers in the country. They have no proprietary products, which is a big reason why we use them. We can go out there and find the best for our clients, and they do have the the SIPC membership, just like all brokers out there, at 500,000, and all that. So if you're working with us, you'll see LPL Financial. They're kind of behind the scenes as well, but we're really your main focus and your point of contact. That we're here to take care of you. And got to put up the important disclosures for you to read. So there you go. Enjoy those. And all right. So do we have any questions?
Let's see. I do see we have one here. So the question is, I heard that tax brackets are changing in 2025. Is it worth it to roll an IRA into a Roth and pay the taxes now instead of waiting until I start making draws in the future to pay the taxes then?
That's a great question. Phenomenal question. Love that. So I can tell you it's very specific, right? There's a lot that goes into looking at those numbers of whether that makes sense, but your thinking is right on, right? Taxes are going up. We know that unless Congress changes something, but it's very likely that they're going to be going up. So yes, looking at some strategies like Roth conversions can be very advantageous to you right now while we have these lower rates. But again, it is very specific. We gotta look at your other income. We gotta look at where you fall in the brackets, things like that. So come talk to us. We can help talk you through that. but that's a great question. I like the way you're thinking there.
I really like how it's, that's one of the things that we do really well here is to go through those individual circumstances,
Hmm.
just to see if, hey, is doing a Roth conversion in this case, is this the right move? So
Right.
it's really nice to have somebody, there to chat through that with.
Yep. Yep.
Let's see.
What else?
Well, hmm, I don't see any others yet. We'll give it here
Okay.
just another
I'll get back.
minute or two. Um, hmm.
We covered it all. We covered
We
it all,
really,
Drew.
apparently we did, we nailed it. Let's
Looks like
see.
somebody raised their hand. How do we, do you see that?
I did.
There
Hmm,
might be some in the Drew, obviously in the Slack, and then the
sure. Oh yeah.
uh, I wish I could call on you. I know you raised your hand. I wish.
Like, yes. Oh, here we go. Hmm. It's kind of funny because it's like I was thinking about I always find it interesting where sometimes people's sentiment on how they feel about the market is sometimes tied to the weather. You ever noticed? It's like, oh, hey, it's so cold. Like, maybe I don't know if things are going to get better, And so it's always kind of an interesting thing to push yourself out that 6 months, that year, that 2 years, just to really gauge where you're at and how you're feeling about everything.
Mm-hmm.
Um,
Mm-hmm.
all right, so
It's good. It's a good comment, Drew. It's a good point.
mm,
We can invest in accordance to our like beliefs as well. I know
mhm,
politics is a big one, and I totally get where people come from in that. I mean, that's normal. And we really try to help you kind of step back from that, and um, we invest based on what we've seen over the last 100 years, and
yeah.
yeah.
Let's
Anything
see.
else? Any other questions that come through?
Let's see. Are we able to go back to the phone number page here, Deej?
Oh, maybe that's yes. There it is.
Okay.
Although you can also, let me go. There we go.
Ah, perfect. Yes, we want to make sure we get that question, you know, answer that
Hmm.
for you. Mhm.
And if we can always reach out. I did see who that was, so we can always reach out
Okay.
to you as well. Yeah, if we don't have any other questions, we'll let everyone go though. And
Yeah.
yeah, thanks for joining. Thanks, Drew, for being here.
Of
That was
course. Thanks
fun.
for thanks for giving us such good information. It's always a pleasure.
Yes, absolutely. Well, hope everybody has a great 2024. Let us know if there's anything we can do to help you and your family. Bye bye.